Good afternoon. My name is Paul Rickard and welcome to our Switzer webinar being the 2nd of May. It's just after 12:30 p.m. Eastern Australia time. And thank you for joining us for our webinar this afternoon. With me is Peter Switzer. Good afternoon, Peter.
Hello, Paul. Hello, all webinees. Nice to be with you.
Okay, well, I have some questions for you in a minute, Peter. So just before I do, a couple of things that just to start the broadcast. Of course, the obligatory disclaimer that says that in answering your questions today, and some of those have already come in, we of course don't know anything about your individual circumstances or your particular financial needs or objectives. So our advice is general of nature, and of course, if in any doubt or you hear anything during the broadcast you have any questions about, you really should then go and speak to the appropriate advisor about whether that is something you should act upon. So it is general in nature, and you need to understand that, of course, we don't have access to your personal needs or objectives. The other thing is for a housekeeping matter. So if you can close all the applications and programs that are not in use on your PC, that'll help. Make sure the volume, of course, on your computer or speakers is at the right level. And of course, during the telecast or broadcast, you can send in questions during the questions box, which should be visible on the bottom right-hand page of your screen. And when we come to you, if you do have, we'll see if you can actually want to ask us the question directly. We'll unmute your microphone if you do have a microphone or something you can use in your PC. If, of course, you can't do that, we'll just read the question for you. I know some of you have microphones and some don't, so sometimes that helps add a bit more detail and information to the question. The other thing I'd just like to mention that we'll be pretty particular about time. We know a lot of you have got other commitments, so we'll make sure we wind up this webinar just before 1:30 Sydney time. So if you do have other things to go to, you can work on that basis. This will finish by that time. Okay, so look, I'm going to start with a couple of opening observations, Peter, and it is the 2nd of May. But, sell in May and go away.
Well, I guess this week in Australia that we have been selling. I looked at the history of it on the Switzer report, and the last 25 years, 9 times out of 25 you would have made money if you sold in May and went away. Till the second week in September. That was the old St. Ledger Day in the UK. However, there's also, most of the times when that has worked, there's been big dramas, you know, like the GFC. There's 2 years around the GFC, it worked. When America was downgraded for its debt, 2012, it worked then. And Mario Draghi dragged everybody out in 2012 when he said, whatever it takes. .com bust. It worked then too. I don't see that sort of thing happening this year. However, I wouldn't be surprised to see some kind of sell-off in May, and I'd be saying, well, wait for the sell-off, buy in at the sell-off, and then stay. And that's been a pretty good strategy, you know, waiting for the sell-off that could come and buy. Because I do think this market, I know I had Lance Lay on my TV show last night, and Lance was optimistic last month, and Australia did pretty well. But when you look how far away we are from the 200-day moving average, and I'm not a person who just purely believes in technical analysis, but when there's a big gap between even the lows on the stock market and the 200-day moving average, it makes me think this May might not be a very bad May at all.
Okay, well that leads me to the next point, which I think, you know, our medium-term view is that this market will get to, well, we're going to see 6,000 in the next sort of 6 to 9 months. The question is how it gets there.
By the way, consensus of all the experts now is 5,900. So they're not far off us now. They weren't there at the beginning of the year.
They weren't at the beginning of the year, and we have already been over 5,500, and so maybe that's sort of making me a little bit more nervous. But the question is how it's going to get there, and we, I think, published a pretty strong opinion piece from Charlie during the week about the banks, and he was basically saying that look, it's not the time to sell your banks necessarily, but it's not the time to be overweight. So they've had a fantastic run, and if you are overweight, this is when you might start to reduce a little bit. And if you're probably at index weight or bank weight, you wouldn't be putting more money into the bank stocks. That's, I think, what he was largely saying.
Yeah.
How did you feel about Charlie's opinion?
I just think that if you're a kind of person who invests this way, you buy stocks. So say, for example, early this year, I think Combank got down to 71. I wrote a piece for the Switzer Super Report where I just said, well, if it goes back to 75, where it was before, that was like a $4 gain on 71, and then plus the dividend yield of 5 or 6%. You're looking at close to a 10% return. And it's gone to 79. So if you're the kind of person who likes to take a bit of profit, I'd take a bit of profit, but I'd be buying again if I saw CBA at 77 or 76. So if you're the kind of investor, if you're not, I've got to say, I don't sell my banks. I think CBA will probably see 83 this year. You think it'd be higher, don't you?
Yeah, look, I don't agree with. I sort of take Charlie's point. They have had a fantastic run, and whenever something's had a fantastic run, it makes you nervous a little bit. But I actually think that the only way the market can get to 6,000 is through the banks continuing to power ahead, because I just don't see the other parts of the market leading it. So I'm not in his camp, but if you are getting a bit nervous, then maybe I'm more in the camp that I'm starting to get a little bit nervous in the market. So
yeah. Well, what's also interesting is that Charlie's proposition is the banks are a good proxy for GDP. Now, my view is that GDP is going to improve this year, not go back. Charlie's a bit worried about talk about debt levies and all that sort of stuff, and he quite amusingly called it the Canberra correction. I really wish I'd come up with that smart line. But I do believe that the banks could come off a little bit. Why not cause a buying opportunity and see it right so CBA go up into the 30s? Do you think someone like NAB could go as high as 40 this year, Paul?
Look, I think NAB's the weakest of the four major banks.
That's why I asked you that.
So I wouldn't be investing in NAB. I don't think so. But I think I stick with the strength, Commonwealth Bank, and I think the others have had a good run recently. I think that could certainly plough up to $85 or $90. But I think NAB maybe at 40 might be seeing it out. But look, time will tell.
Can I just throw something for the sake of our webinees? I don't agree with Paul. I don't mind NAB because I think the improvement in the UK means that those assets they hold over there could end up being more valuable than they have been. But it's sort of say, you and I don't always agree, do we, Paul?
We don't. I mean, look, a new CEO starting could be a positive. Probably that's Klein going is for me a big positive long term. He has not been a good CEO of the company. I don't believe, and so that going is a positive. But new CEO will take a while to find his way. So maybe there's upside in NAB in the long term.
I quite like Cameron because he's a sea swimmer. A very gutsy sea swimmer. And he also tried to think outside the square. And then the share price is heading in the right direction, Paul. I think being a bit unfair on Cameron, but move on.
Okay, let's just have a look at the performance of the market in April. I think I must admit I was a little bit surprised even myself when I put these numbers together this morning.
Especially property, because you weren't too keen on property, were you?
No, I have our yield portfolio. This year we put some property back into it through Dexis, and it's started the year at $1 even. It's $1.14. It's had about a 14% gain.
Yep.
So, but I was a little bit surprised, that both on a year-to-date and in the month of March of April, property trusts are the leading sector in the market.
Huge.
And the other thing stand out in that is there's two other observations I'd make about this. One is that it's pretty rare to have most sectors the same direction. So there's not really a lot of difference between the sectors, even though I think you can see some differences there. There aren't too many in the red, and there aren't any super in the green. So that's the first comment.
Yep.
And secondly, in April, we certainly saw a return to favour of the yield sectors. So we had consumer staples. The banks still doing well at 1.3%. Property trust, telco through Telstra came back a bit, and utilities. So really the yield sectors have sort of led the market higher in April. And the so-called cyclicals that everyone was talking about at the start of the year.
Yeah, but that's dollar related, isn't
Yep.
it? And we're all surprised that the dollar hasn't started to sink, but it will. It will eventually happen. And if you're a contrarian investor, there's probably some. Well, in my article on Monday, I basically said that there will be a buying opportunity, and that dollar's really that hard for cyclicals.
So my big question out of this, Peter, is, and we'll get to your questions very quickly, shortly, is just how does the market get to 6,000?
Yeah.
Because I can't see it in the materials with BHP and Rio per se. I mean, BHP will probably do a buyback or help, but there's no sign of the iron ore price really picking up at the moment.
Yeah.
So it's okay. Maybe they're underpriced and good value, but it's hard to see how it gets led. The dollar's really got to get sold, come down a big way to get some of the industrials and health and cyclicals going. So what really takes it to 6,000? And so that's why I think you need financials to be a key part of it. Yeah. And if you're bearish on financials, then I think the 6,000 call might be looking pretty nice.
Yeah, I think materials will hold their own. Macquarie came out with a survey they surveyed something like 80 or 90 major steel producers in China. And their survey showed that demand was surprisingly strong. So they're saying they're not worried about a collapse in the iron ore commodity price. So that's a good tip. So that holds the index at least. I already have argued the case that I think banks will go up because I think the economy is going to grow. I don't know if I'm as bullish as you, at 85 or maybe 83 on CBA, for example. But I do think our big savior could be the last 3 months of the year, which is historically a time when the Americans buy. The last GDP number we got this week was a 0.1%. It was extraordinarily low. It was all blamed on the weather. So I'm looking to the next read on US GDP, which will be in 3 months' time. If that's a really good number, and there are people predicting it'll be a whopper because there's a lot of catch-up, those factories that couldn't produce during the cold, it'll catch up in the next quarter. If that happens, I reckon the belief will be the Fed sticks to its tapering program. Some people start saying the first interest rate rise in the US will be sooner rather than later. Some people think middle of next year. They could start thinking, it might be in the early part of next year if that strong growth number comes through, and then the greenback goes up and the Aus dollar comes down. As that Aus dollar comes down, those cyclicals that you were just talking about could start producing some great results towards the end of the year. Remember, stock markets and currency markets, they get in before the real thing happens. They move on anticipation of the real thing happening. That's my guess.
Okay, let's get to some questions. We've got a few that came in beforehand, so we might just
okay, do those first.
Do those quickly. So David from Sydney's asked about BT, Magellan, and Platinum. He talks about reference in our newsletter of the 28th of April. I must admit I can't find that, but we did talk about it on the 17th of March. Charlie also made a comment about Magellan and Platinum, and I think his comments are those sort of three fund managers. That's who BT, of course, is. Magellan and Platinum a bit out of favour. Look, they've all had pretty good runs this year and seem to have come off a little bit because I think maybe that they got a little bit expensive. I did do a bit of homework, and according to FN Arena, BT is currently at an absolute neutral sentiment ranking. It was 0.0.
Reported well this week, didn't it?
Reported early this week. Credit Suisse upgraded to neutral, but the three brokers following it all at neutral, so that's one piece of data. Magellan is being one of the standouts. It's still rated by the two brokers that cover that as being a strong buy. They see a higher price target of about $13.94. It's come off, as I said, because it was getting priced at a fairly attractive multiple. You go and talk to any financial planners, they all recommend Magellan at the moment. Sometimes that's one of the reasons it's had such a great run, but also, that sort of these things tend to turn around. Platinum, which they all used to recommend, has been suffering from that very problem because a lot of the financial advisors used to reach Platinum now recommend Magellan. And Platinum's been suffering a funds outflow over the last year or so. It's currently got a broker rating of pretty negative at minus 0.7. So, look, I guess in all those three stocks, they're all a little bit, have been a bit overpriced, and that's why they've come off. I don't think they're necessarily sells, but they also would, at least the latter two, will benefit from a weaker Aussie dollar, and again, that probably explains it. So, brokers are basically bullish on Magellan, neutral on BT, and bearish on Platinum.
Yeah.
So, thanks for that question. I want to keep moving. I can, Peter. Tony asked a question about Investor and the takeover by APA of Investor. But from far as I can see, this is pretty well a done deal. It's got a recommendation from the independent directors to accept. The APA share price has gone up since the takeover was announced. So you've got essentially, if you look at where Investors trading at $1.15 and APA is trading at $6.66, the market's telling you that Investor is going to go. APA will win that. So it's a question of whether you want to get the script access or you want to perhaps take a chance with a little bit of cash. My inclination, given where APA has gone and some of its plans, it's pretty well-run utilities. You might go for script.
Yeah, I think so too. I think APA is a good company, well-positioned, and I think they've done okay with this deal.
Yeah. Look, what is going to happen is APA will be successful. The market's telling you by the price. This is going to go through, so you're better off making the decision now rather than waiting at some stage to be compulsory acquired or whatever the next step is. So
yeah,
you may as well control your own destiny and either take the script or take some option around some cash. Okay, so this probably comes to where we were. I took Julie's comment around not so much the go away may, but the idea about being able to wait for the correction, Peter.
Well, I looked at Julie's question, and it just seems to me that if Julie is that kind of investor, you're a timer, and when you time, you win sometimes and you lose sometimes. I would recommend Julie have a look at my interview with Lance Lay last night. The charts do not make you feel nervous at the moment. So I would be inclined to say if you are prepared to sell out now, you might wait 3, 4, maybe 6 weeks before you see something that might make you feel as though you made the right decision. I do think there will be a correction of some kind this year because, as you pointed out, the Yanks are at all-time highs. But I do not see it being Armageddon. As long as the Fed's got a loose monetary policy, which it has, and US companies are reporting usually better than expected, it's going to need a left field event. And I know people like Dr. Mark Faber is tipping that kind of thing, a 50% crash in the stock market, but he's been tipping that for about 2 or 3 years. One day he will be right, but at the moment I can't see the real trigger for it. Paul?
Yeah, look, the way I approach the market, Julie, is I can't time markets. So what I tend to do is just change my allocation a little bit, or alternatively, if it's, and this is easier in the accumulation phase and the pension phase, you can also just time the urgency around contributions a little bit. So if I'm bullish on the market, then if I have cash available maturing on a term deposit or something, then I might put that into the equities market. Or if I have some contributions to be made at some stage, I might accelerate the contribution plan so I get more money into equities if I think this is the right time to buy. If I think the market's going to correct, I don't necessarily sell, but I don't make any new investments. And if there is something maturing by the way of cash or a term deposit, I'll roll it back into cash or a term deposit. I won't change the allocation. So it's more, I don't think I can time the market. I approach it about, is it the right time to buy, or is the correction as to really around the margins as to timing and entry for the market. Does that make sense?
Yeah, I think so. I think it depends on the way you invest. And I've got to say, if you're in the capital gains tax-free zone, well then sometimes you can buy and sell whenever you like. But some people will not sell because they don't want to pay the capital gains tax, which could be more than the potential loss of hanging in there. And other people also they will dollar cost average every time a good company like drops in price. So it purely depends on that, Julie, and the way you invest. So from my point of view, I think a correction will come, but I do not think it's going to be a real big correction. I think it'll be a 10% or 12%, and there'll be more in America than in Australia. So I just think I'm not as worried as you are, and therefore I'm not sort of going to be adopting the kind of strategy that you think might be relevant for you, and that might be relevant for you.
Okay, let's get to some questions. We have a couple on the same theme from what I can see, and one's from David, and I have also a question from John about the budget and some impact on some shares. So we might go to, I might just put up John's question, but also if we just get from David. Tom?
David, are you there? I've just unmuted your microphone if you'd like to go ahead with your question. David Ng, excuse me if I'm pronouncing your surname wrong. Are you there, David? No, well, David...
Okay, so I think... So David's question is very much along the same theme, Peter. We've got the budget a week and a half away, and if we get a levy and high-income earners and people come out, we get the Canberra, what was the phrase, Canberra correction. What does that mean to some of the, I suppose in particular, some of the discretionary retailers and other stocks? Which stock could be impacted by a
Harvey Norman
budget?
Harvey Norman, JBH, JB Hi-Fi, those sort of consumer discretionaries. And the reason is, let's face it, the analysis we saw was 80,000 as a starting point, 1%, that's $800. Well, excuse me, but didn't the Rudd government actually send out checks close to that amount to try and stimulate the economy during the GFC? They're about $900 checks. So I think consumer discretionary stocks would be affected by a levy. And by the way,
the bet $800 is incorrect, right? That was reported incorrectly by the Telegraph and the Herald Sun.
Yeah, we always know that they often throw a worse number out and make it smaller. But still, even if it's $400 impact on an $80,000 person and 2% on a $400,000 person, that still end up being a pretty heavy slope. And I just think that we don't need this. The economy doesn't need a tax flag at this point in time. So I think it will be a negative for those consumer discretionary stocks. Would it affect the financials, Paul?
Look, I don't think it really should affect the financials. I mean, I don't think there's a much bigger impact on interest rates. I mean, one of the challenges with budgets, of course, is that the market will generally do better when we've got stronger growth, and that'll a lot of companies, not just the discretionary retailers like JB Hi-Fi, but obviously the banks, because of economic growth, should mean eventually more credit growth, so that's good for banking. It should be good for a number of the other retailers because it'll flow into even with what the consumer staple companies like Woolworths and Wesfarmers get. It will flow in at the end of the day into some of the smaller industrials because they're also impacted by local purchasing. So generally, stronger economies should be better for all stocks or most stocks, and so any sort of negativity won't help. But you'd expect the consumer discretionary companies to be most impacted.
A company like Reject Shop might do okay if there's an impact on consumer confidence, being a low-cost operator.
Yeah, I mean, so the other question to be careful of here is that we've already seen some impact in the market this week on those stocks, and I just want to make very clear that the report by Terry McCrann on Wednesday was incorrect because it wasn't a 1% levy on up to $80,000. It was a 1% levy on people starting at $88,000. So for someone earning $100,000, it was only going to be $200, not the $1,000 he reported. So we did actually see the impact in the market. So that story, let's wait and see. The other group that's being affected, and there are arguments whether it's positive or negative here, are some healthcare stocks. Mainly primary that's copped a bit of a beating, but I've seen some research that suggests that primary would actually be a winner out of the co-payment because the plan with the co-payment is it will be collected by the medical practitioner people will then keep the money, cash in hand, and the rebate levy from the government will be reduced, and they'll largely do it by changing indexation. So it's not a question of the doctor actually having to collect the $6 and send it back to the government. The doctor actually will keep the cash, and there won't. It'll be done through changes to some of the indexation rates around how the rebates work. So it actually, for a group like Primary, brings revenue ahead by about 12 months. So there's all those sort of impacts, but longer term maybe it's a negative because it might reduce demand for
less demand,
for some medical services. So there's just something to be worried about, or not to be worried about, concerned about. So I think,
well, the flip side is that infrastructure companies could benefit from the budget as well, Paul.
they could.
So it's not all going to be negative. The budget actually could have some positive implications.
Because of how government might be spending the money.
Yeah, that's right. Yeah. Precisely.
Okay. All right, Tom. We want to just we got a question from on Bank of Queensland there.
We did indeed, from David. David Downey, if you're there, David, would you like to go ahead and ask your question?
Are you there? I was just wondering what you think of the big banks have had a big run. What do you think of Bank of Queensland and Bendigo as investments, or are you still with the big banks? Thanks.
Well, we were on Bank of Queensland for about $7, weren't we, Paul?
Yep.
I'm still positive on Bank of Queensland. I think their deal with Investec is going to be good for them. I think they're diversifying their profit centres, but you don't expect to see their share price rise like it has over the last 12 months. But I think Bank of Queensland is still pretty good. Bendigo Adelaide, probably in the same kind of category. I don't know as much about Bendigo Adelaide, but I have been watching Bank of Queensland. I've got a relatively positive view on them. Paul?
Yeah, I have perhaps a slightly different perspective. I think they were extraordinarily cheap about 12 months, 18 months ago. And they have been, the regional banks have done over the last 18 months better than the major banks. Now, they got actually punished post the GFC, and that's why the reason they had a big opportunity to improve. My inclination, if generally people are starting to feel a little nervous on the banks, I think you stick with the safety, because if banks are going to do it tough, the regionals will do it harder, simply because they are always going to be more vulnerable to any sort of concerns.
Yeah.
So I prefer the major banks, and that's why I've been running my portfolios this year.
The one thing I'd say between Bendigo Adelaide and Bank of Queensland is that if you start looking at the economic data coming through, Queensland as a state is getting stronger, and real estate in that state is getting better than it was ever before. Now, a lot of the improvement of Bank of Queensland was on the anticipation that real estate was starting to improve. But I think there's going to be probably a window where Queensland, and even the ads they have on TV at the moment where the government is asking people to... I like that. It seems like the leadership is actually, anticipating something's going to happen there. So because of the base of Bank of Queensland is Queensland, and Queensland's getting stronger, and a lot of infrastructure spending could be there, I'm more confident that BOQ could be a nice little riser as opposed to a shoot the lights out type riser.
Yeah, I think between the two, I prefer Bank of Queensland over Bendigo.
Yeah.
But I think I'm still a major bank person at the moment. Okay, why don't we go to, we've got a question on G8, is that right, from Peter?
Yep, certainly, Peter Hart. I'll just find you and unmute you one moment. Peter, are you there? Would you like to ask your question?
Could you please comment on GEM and your feeling as to whether they're becoming too acquisitive and whether they're still maintaining their discipline of purchasing at 4 times EBIT? And secondly, their current SPP, would you think that's worth investing in?
Peter.
Yeah, G8, of course, I was given very early tips on G8 on our television show. I think Roger Montgomery was pretty early onto it. I feel as though it's run pretty hard, and I'm kind of hesitant to tip people into it now. So I find it very hard to be enthusiastic about because it has such a big run-up. That's my view on G8.
Yeah, look, I think your comment earlier that companies that are very acquisitive, you tend to find they reach a level where sometimes those acquisitions just get a little more marginal, and some years later we suddenly realise that they're a lot harder to put down than people think.
Yeah.
And I think a good example in that case is someone like QBE. Couldn't do anything wrong on the acquisition front for a number of years, but look at QBE today. So I can probably point to quite a few other examples.
Yeah. And Paul, also, what actually could be good for the business 2 to 3 years down the track might not show up for a couple of years in terms of earnings, and that could then affect their share price. And that's the worry me about GA.
I think in relation to the share purchase plan, I don't know the issue price versus the current price. I think you've just got to look at the, the first question is, do you want some more shares? That's the first question to answer. And then the second question, if you do, what's the best way to purchase those? Is it through the share purchase plan or on market? If there's not much in the share purchase plan and you're not very bullish on the company, then give it a miss. If you like the company and there's a reasonable discount, then go for it. And I just don't know how that's trading at the moment to comment on that. Okay, let's move to the next one there, Tom. AUD Outlook, from Michael.
Michael Coe, are you there? I'll just unmute your microphone. Michael's no longer on. Yes, he is, Michael. Are you there? Would you like to ask your question? I think we can hear you there, Michael, if you'd like to go ahead. No, Michael was just asking about the short to medium medium-term outlook of the Aussie dollar.
My view is that Aussie dollar could sneak up over the next few months, and I think we'll start seeing some softness towards the end of the year. I hope I'm wrong because I'm taking my television show to the USA in November and I'd like the dollar to be high. But I have a funny feeling that if my views on the US economy are right, the greenback will start sneaking up and the Aussie dollar start coming down. And next year, 2015, I think we'll start seeing the Aussie dollar dropping more substantially and the greenback really picking up pace, particularly in the second half. That's my view, Aussie dollar. By the way, toughest thing in the world to predict, Aussie dollar.
So down but not yet.
Down but not yet, and it'll go up for a while, I think. In fact, Lance's charts actually pointed to that last night. Up.
Okay. The next question there, Tom, is what's this opportunity for corporate bonds from John?
Yep, from John Lene. I'll just unmute your microphone there, John. One moment. Oh, sorry, John, I'll just find you quickly. John Lene, yes, are you there? Would you like to go ahead and ask your question?
Yep, okay, hi. Look, I'm supposed to have some of my investments in cash, and I really find it difficult to invest in a 6-month term deposit at 3.5%. So I've sort of compromised in my mind, and I've decided to buy some corporate bonds, which I haven't done in the past. So I'm just looking for some suggestions, if there are any, on which sort of companies are better than others, I guess.
John, it's a very hard thing to do because the retail market doesn't readily exist. So you're almost forced to go to some of the wholesale brokers that will wholesale some of those bonds to you, companies like FIG,
Yeah.
are options you can look at. I'll give you a couple of other ideas. One is you could look at some of the listed hybrid securities. Now, they're effectively like a corporate bond, although they're at a floating rate, but they're obviously providing you with a margin over the bank bill or term deposit rate. So that's one option. So you could look at some of the listed hybrid securities. Apart from that, there's a few things like some of the mortgage trusts around, which have come back into vogue again, which are offering a slightly higher yield. And then, thirdly, don't forget around some of the things like the property trusts, which may or not be an asset you want to look at, but of course they're effectively like an annuity-style investment. So there's some other options, but there really aren't a lot of options from corporate bonds outside. You go to a couple of the wholesale brokers.
Paul, I was interviewing Mark Payton, the CEO of FIG, on my show this week. So, John, if you missed that interview on Switzer, you can go at the switzer.com.au website. Mark Payton interview will be there. He was saying that they have sort of corporate bond products that have yields a little bit over 6. Maybe you should explain to John what FIG does to make it easier for smaller investors to get into the corporate bond space.
Yeah, well, look, it's pretty straightforward what it does. Most of these corporate bonds there is a market and they're issued to institutional investors, but they generally are parcels of $500,000, sometimes $5 million. And effectively they've put them together and introduced sort of like a synthetic custody or a sort of a quasi-custody arrangement where they don't parcel the bond up, but they actually allow you to buy into the bond through a custody type arrangement where you own 1/10 of the bond or 1/5 of the bond, and you with some other people have an interest in it. So they effectively almost like unitize another corporate bond to allow you to buy it from parcels of $50,000 or $100,000. So they're one of the people in that space. There really is very little else I can suggest, and so I don't, worry about corporate bonds too much. I also think you've got to be very mindful that if we're right that at some stage later this year or next year interest rates go up, you probably want to make sure the term of those bonds is fairly short too. So the reason interest rates are so low and what the central banks have done is to drive us to buy growth-based assets, riskier assets. That's what the central banks want.
But Paul, it's probably a good idea even just to flesh out the issue that some people worry about bond funds because when interest rates rise, bond funds often lose. But these things that you're talking about, you are actually getting an average of yields. You might, in the future, there might be higher yields, but you don't actually suffer a real loss if you lock into these bonds.
Sure. If you hold the bond to maturity, there is no loss.
Yes.
But if you're getting 5 or 6% and interest rates are now 10%, there's an opportunity cost.
Yeah. And so your point, and so I'm trying to emphasise, John, the short-term nature of it is probably advisable.
Yeah. I mean, I think this is why I think we've got to be mindful. The reason interest rates are so low is they want us to invest in real assets like property and companies and riskier assets, and so this may not be the right time to be buying corporate bonds, right? And because for a number of reasons, including margins have come down, so that's why I'm just putting that caution. Just want to go back to John. Is that answer his question? It's not a very good answer, but I don't have a lot of ready answers.
You there, John?
Yes, fair. Yes, I am. I can hear you.
And does that answer your question?
Yeah, so John, are you happy with that answer? That's basically...
Yes, I'm happy with you made some very valid comments.
Yeah. Okay. It's an interesting time to do it. I think the starting point is go look at a company like FIG, that's F-I-I-G.
Okay, we've got a question from Robert.
Bear with me, Robert, while I find you and unmute you. Robert Bauer. Would you like to go ahead, Robert? You're unmuted there.
It's a great term, unmuted, isn't it?
It
I'd like to mute some kids sometimes.
doesn't sound like Robert has a microphone, so he was just
Okay.
asking, in fact, he was the second person to ask which sector has the best outlook at the moment, and which company in that sector would you have a look at?
You go first, Paul, so I can think.
Well, that's a really good question. That's sort of like the $64 question. This is, I suppose I'm going to stick with a safety because I've been a little bit disappointed with the so-called cyclicals this year.
Yeah.
If you look at my portfolios, they're overweight in the financials, they're overweight in the health sector, which has been disappointing. They're overweight a little bit in the telco, and basically sort of index weighted some of the others, et cetera, et cetera. So I think probably if I had to say which of those sectors I think is probably looking the most attractive at the moment, it's probably health, and that's because it's been the biggest disappointment. I take a view about the health stocks that Australia's a leader in health, and it's something we would do really well in terms of that, and if we get a weaker Aussie dollar, that'll really help the health sector, but we haven't seen it this year because the dollar's gone up. So but that's why I take an approach across all sectors, and I think it's so hard to answer that question. In financials, I think Commonwealth Bank is clearly the best price of the major bank stocks.
I'm going to give you an unusual answer. I'm going to refer you back to the story I wrote on Monday where I said, if the dollar's going to fall, let's chase dollar-sensitive stocks. And so I'm going to give you companies that are very sensitive to a fall in the Aussie dollar. So, of course, CSL, but everyone tips CSL, and that probably fits in with Paul's health view. I was really surprised to see that UBS is pushing QBE. Two divisions, both the investment bank and the head of Australian equities, Yakov Malish. He thinks QBE is now a buy. He thinks the worst is behind QBE. That's a courageous decision. But I also like, I like his strength of support for ResMed.
Mm-hmm.
He says, a lot of cash on the balance sheet, will benefit strongly from the fall in the Aussie dollar, and it fits the bill. It's a quality company. And so that, I think, might be a really interesting play, and it's the kind of company that I'm going to be looking to add to my portfolio, based on my own advice, that the dollar will go down, and I'm not currently holding ResMed. I think I might do it.
Okay, let's go to a question there from Annette, if we can get to that, Tom.
Annette's actually no longer on the line, but she was just asking about, she's in a 2-member SMSF and wondering the benefits tossing up between individual trustee or company trustee.
Okay, Ned, our very strong advice on this, most people do not take this advice, so I'll put that caveat, but if you have a chance, you should use a corporate trustee rather than an individual trustee. The 2 or 3 critical reasons are as follow. First of all, it's so much easier if the assets are in the name of a company rather than the name of individual trustees. If one of the trustees changes, you have a death of one of the trustees, you bring in a third trustee, whatever it is, you've got to change all the names of your assets. So it's much easier to have a corporate trustee. It survives. Secondly, if you are looking to invest in, take out a limited recourse borrowing arrangement, corporate trustee was much more attractive to the banks than individual trustees, so you'll be able to borrow more money. And thirdly, as we'll talk about some coming additions, there are some new penalties coming in for trustees, tax office, and they'll apply to individual trustees equally, whereas only to a single entity in terms of the company. So it's another reason to have an individual trustee.
It's a cheaper penalty.
There is no downside with having a corporate trustee apart from the costs of the setup. And thereafter a $44 annual fee to ASIC.
Paul, some people might be asking, how difficult is it to swap from individual to corporate, and what's going to cost?
That's probably a little more work because it will require a change of name of all your assets. And You know, so we're going to cover that in a coming edition. But
yeah, it's a really good one to cover.
For someone setting up, I would 99.99% of the time say go for a corporate trustee. Okay, so let's just keep. I want to go to one question here, Tom. I've got here as well, which we didn't deal with. About a portfolio question from Peter in Hobart. And you can see on the screen in front of you, Peter's currently got about 70% in shares, tiny bit in listed property, bit in cash and some other. And it's been suggested you should diversify by establishing a portfolio of diversified bonds. Any comments on that? We don't know his objectives. It makes it a little bit hard, Peter, but just any sort of thoughts off the...
well, at this stage, he's balanced bordering on growth, isn't he? He's got 70% in stocks. I'd be happy to, for example, if he had 10 or 15% in bonds, but do we know how old he is?
He says he's transition to retirement, so I think we'll guess he's somewhere between
55
to
60.
And 60, most likely.
Well, going long on bonds in this stage is a little bit preemptive, isn't it? Given the fact that he could live to the 80s, diversified bonds is sort of the play that you'd take on if you're getting really conservative, Paul, wouldn't it?
Yeah, look, my guess is I think you've really got a pretty high growth portfolio there. I don't think it's more balanced. It's about 75% equities and 25% in other assets. Look, maybe I think you look at changing that balance a little bit more back to a little bit less growthy, and maybe
what, 50% shares? 50% shares?
Yeah, 50, yeah, probably that, and then maybe some property might be the way to go. So, look, it's obviously we don't know your objectives, and that's why it's so hard. But my gut reaction to that is that you could afford to be a little more. It's a reasonably aggressive portfolio, so that's.
And also, we don't know the size of his fund as well, and we have to work out what kind of income he wants to live on, because a diversified bond portfolio is not going to give you a massive high return. It's going to be an okay return, but not a massive return.
Right. Let's go to Chevenez.
Okay, Chevenez, just tracking you down now. Hold the phone or the computer. Okay, Chevenez. Yes, if you'd like to go ahead and ask your question.
I would like your comment on Oil Search. They have come out with share purchase plan. Should I be applying for those?
Peter.
So can I see the question one more time? I had difficulties. Oil Search, I know.
Oil Search. And the share purchase plan.
Chev, how exposed are you to Oil Search? You have a big holding?
I have no, not really. No, a small holding of 1,000 shares.
Okay. You know, and how long have you held Oil Search for?
For 5 years.
About 5 years. So you know that there's always a bit of volatility with Oil Search, don't you? Well, because of the volatility of Oil Search, I've just never been a great fan of the company. But I know a lot of the experts on my show regard it as being a pretty reasonable company. So I'm not going to put the thumbs down to it, but I'm not going to actually just say, go into it with your ears pinned back.
Look, I'm a bit in the same camp as Chevenez. I not a company that I have ever really wanted to invest in.
It reminds me of Atlas Iron. Atlas Iron goes up and then goes down.
Yeah. Look, in terms of the share purchase plan, if you want to invest in it, look, by all means go for it. Whether you go, as I said to the earlier call we had about the share purchase plan, I don't know the details of
the actual discount
versus the current market price, but just do your sums about the cost of actually buying on market when you pay for brokerage versus the cost of acquiring through the share purchase plan. If the share purchase plan is attractive, it's got enough of a premium in it, and you want to invest, then by all means use it. If you don't have the cash, don't want to invest, or it's a very marginal proposition, then throw the share purchase plan in the bin.
I think the sector's good. I think energies is still a good sector. Yep. But, if you believe in the global recovery, which I do, energy's going to do okay. I'm just not quite sure of the the things that drive their oil search price up and down. I sometimes ponder about the company itself. That's my own amateur position in the company.
Okay, where are we going next, Tomo? Overseas, we've got a couple of questions on overseas investment.
Overseas investment. Just wondering, Robert Bauer again, whose microphone wasn't working, wondering he wants to get some overseas exposure, and would you suggest America, Europe, or Asia, and which sector in this region would you suggest?
I'd be inclined. Look, America would give reasonable returns, but we know the Dow is at the all-time high. But you can shoot probably, there are a lot of people telling me 19,000 on the Dow, so there's still plenty of upside there. And I've got to say, if you buy, for example, an ETF on the S&P 500 and it continues to go up, you could make a play where you sell out when the Aussie dollar falls, and that could be a nice little even currency gain as well. But I would be looking at really good fund managers who understand Europe, because I think there's potential in Europe because they're recovering and they've got 2 to 3 years before they're growing a lot stronger. And I think there's potential in Europe. But I'll be doing it through a fund manager, I think, in Europe, and maybe an ETF in the USA, unless you want to go specialise in picking certain companies out, which is a lot tougher. Though I've got to say, during the week I was asked a question about Bank of America, and they've recently copped a bit of a clobbering because of a legal issue. And I asked Marcel von Pfeiffer from Arminius Capital what he thought about Bank of America, and he kind of used the same analysis that Paul often uses with the CBA. It's the biggest bank in America, and because the Fed is keeping interest rates really low in the USA, the US economy should do well, Bank of America should do so well, and because of the legal problems they've had, it's dropped about 19% recently. It could be a good buy at these levels.
Peter, you mentioned ETFs. We've just had another question about what's the best way to actually get that exposure into international shares. Would you suggest ETFs or?
Well, I think ETFs, it can be a good way. I was recommending it 2 or 3 years ago when the market was a lot lower, but I think if you haven't got expertise in knowing these companies, you either have to do it through a fund manager or you have to do it through some kind of product like an ETF. That's my view.
Look, I'm also probably look at Europe rather than the US. Asia probably not for me, more so because I think if there is one of the risks out there is the fear that interest rates in the US will go up at some stage and the US dollar will appreciate rapidly. And we saw what happened when there was a few whiffs of that about 6 months ago, and the Asian markets just got pelted.
Yeah,
because of the flight out of the currency risk out of some of those economies. So there's much higher risk. I think if you are looking at Asia, you have to look at it through a fund manager because some of the funds really don't give you good exposure. And maybe you do the same with Europe. The US market, I'm a bit more confident about using an ETF in because I think it is so index-driven in a way. But look, there's lots of things to play with it.
In fact, the Switzer Super Report should actually review some of the emerging economy fund managers. Yeah.
Yep. Okay. We've got 3 more questions to pour through, Peter, if we can. So we'll keep the answers. There's a question of Iris from, is it Derek?
Derek, one moment. I'll find you and unmute you. Derek Tolson. Sorry, we've got lots of attendees today. Derek, are you there? Would you like to ask your question?
Yes, thanks for taking the question.
Sure.
I hold quite a fair bit in Iris, but it's part of a balanced portfolio. Just it's come down a hell of a lot lately. Just your thoughts on where you see it going, especially with its overseas purchase of Evenco and some of these other areas that it's now getting into.
Yeah, Derek, I've got to say, it was such a darling of the stock market a few years back, and it really has struggled over the last few years. I don't know what's wrong with Iris, so I'll tell you what I'm going to do. I'll get the CEO of Iris on my show and try to find out what's going on there. Because a lot of people still regard it well, but gee, it's just not delivering on the stock market. And I just don't know. Paul, do you have any views on Iris?
Yeah, I do. Look, I think it just got too acquisitive. And I think some of the things it's bought offshore, its investments in South Africa, it's really become more, not so much a markets piece of software the way it started. It's really now the financial planning software. It's its big business, and I just wonder whether it's got one of these companies that got too acquisitive.
Yeah.
And it's just the pains of digestion. Getting these offshore acquisitions to work is. Australian companies collectively have an abysmal record of investing offshore. Every I see people talk about that as a reason to buy a company.
Yeah.
Crawl back in horror.
Yeah. The interesting thing is Iris could be a company that benefits from a lower dollar. But Derek, I won't get him on this week. I'm full this week. But the week after, I'll try and get the CEO on. We'll talk it over.
Okay, question from Janice, I think it is, on ALS.
Denise, would you like to go ahead? You're unmuted there. It doesn't sound like we have Janice. So Janice's question was on ALS. Stock code is ALQ. She noted that it went up after doing the 5-for-1. Excuse me, I'm just quoting directly here. It went up after doing the 5-for-1 for people who had Campbell Brothers. It rose to about March. It rose in March last year and then dived to around $7 and has never really recovered from there. Where do you think it will go? Because there didn't seem to be an explanation for the drop.
Okay, the company again?
ALQ, the stock code. The company is called ALS Limited.
Okay, not strong enough.
Look, I'm going to have to pass on this, Janice. I don't know enough history about that. That's that company.
Yeah. But that's another one I'll try and follow up on the television show, ALQ. All right.
Okay, look, it's 29 minutes past 1, and I think we've got pretty well every question, Tom, haven't we?
Covered all the issues.
There's one company on the Spotless Group IPO that's just come in. Look, I'm going to do a bit more work on the Spotless IPO. It got a bit of a mixed review, Peter. Have you done it on your show?
Yeah, nothing on the show is yet, but I'll follow up as well. So I don't want to put my foot in. My initial impression's not breaking my neck to be a part of it, but I need some more information before I confidently give a thumbs up or thumbs down.
Okay. Yeah. I think we probably need to. There's one question there on just from Michael on Genworth, which I probably can answer.
Yeah.
Did we cover that one?
Michael Coe, I'll just find you and unmute you there. Or did we cover that already? No, we didn't. Michael, are you there? Would you like to ask your question? No, Michael's microphone isn't working, but he's just asking about who are the brokers for the Genworth IPO.
Okay, look, it was covered in our report on Monday. The brokers are Comsec, JP Morgan, UBS, Macquarie. I think there's one other. So I know Comsec's currently got it. If you're a Comsec client, you can get it on their screen. Look, for me, nice yield. Pretty tough business, and maybe invest in moderation. My advice on that one.
The one thing I say about Genworth, Paul, is I know you have spoken about maybe the parent could actually try to reduce its exposure, but Genworth is a pretty good operator. During the GFC, they didn't miss a beat. In Australia, the Australian subsidiary is a very strong operator. And as I say, didn't miss a beat during the GFC. And remember, their job is to ensure quality.
Yep. Okay, look, it is 1:30. We're going to wrap it up there. And thank you very much for joining us this afternoon. I'm sure that we stand by our commitments, because I know a number of you have other things to go to this afternoon. And thank you for joining us on behalf of Peter Switzer. This is Paul Rickard, and we'll be back with you next month, and we look forward to your questions and feedback in the meantime. And of course, Peter will be out with our Saturday edition tomorrow.
Yeah, up bright and early writing it.
Up bright and early. Thank you very much, and we'll sign off from today's webinar. Thanks for joining us.
Thank you.